Chapter 11, Advanced Risk and Capital Preservation. Section 2, Portfolio Risk. Portfolio risk means the uncertainty of returns for all your investments taken together, not just each one on its own. The key idea is that total risk depends on how those assets move relative to one another, so it is not simply the sum of their individual risks. When holdings do not rise and fall at the same time, diversification can smooth the overall portfolio and lower total risk. Standard deviation is a practical way to think about portfolio risk because it shows how much returns tend to vary around their average. A lower standard deviation means steadier results, while a higher one means wider swings up and down. Variance is simply standard deviation squared, so it is often used in formulas, but standard deviation is usually the easier number for investors to interpret. For a two-asset portfolio, variance has three parts: each asset's own risk contribution, shown by its weight squared times its variance, plus an interaction term, 2W1, W2, sigma 1, sigma 2 rho 1, 2. That third term captures correlation, or how the assets move together, which is why total portfolio risk is not just a weighted average of the two individual risks. Correlation measures how closely assets move together. +1 means they rise and fall in sync, 0 means no clear relationship, and -1 means they tend to move in opposite directions. For a portfolio, lower correlation usually gives better diversification because assets that don't move together can reduce overall swings. But during market stress, correlations often rise, which can weaken diversification just when capital preservation matters most. Not all risk comes from the same place. Systematic risk is the kind that affects most assets at once, such as recessions, inflation, or interest rate changes, while unsystematic risk is tied to a specific company, asset, or sector. Diversification can help reduce unsystematic risk by spreading your money across many holdings, but it cannot eliminate market-wide risk. In other words, diversification lowers company-specific shocks, while broader market shocks still remain. To estimate portfolio risk, start by making sure your asset weights add up to 100%, then find each asset's standard deviation and how the assets move together using correlation or covariance, which is standard deviation times correlation. From there, calculate portfolio variance with the weighted formula and take the square root to get estimated portfolio volatility. Volatilities and correlations can change over time, so treat the result as a useful estimate, not a guarantee. With 60% in asset A at 20% volatility and 40% in asset B at 30% volatility, a simple weighted average gives 24%, but that is only a comparison point, not the true portfolio risk. Because the correlation is 0.3, the assets do not move perfectly together, so the portfolio variance is 0.03744, and the standard deviation falls to 19.35%. That means diversification reduces risk by 4.65 percentage points. Diversification is about how your investments behave, not just how many you own. A portfolio filled with several technology stocks may look spread out, but if they tend to rise and fall together, they still share much of the same risk. And if a new holding is only a tiny position, it may barely change overall portfolio risk, especially when correlations rise during market stress. Standard deviation counts good surprises and bad surprises as the same kind of volatility, but investors focused on capital preservation usually care much more about losses. Measures like semivariance look only below a target, and value at risk estimates a potential loss at a chosen confidence level. For example, with 5.6% monthly volatility, a simple 95% one-month VAR is about 9.21%, or roughly $9,210 on a $100,000 portfolio. These downside measures can be very useful, but they rely on assumptions and models, so they should be used alongside other risk tools. To preserve capital, think beyond the average volatility of your holdings and focus on how position size, asset risk, and correlation interact, especially when markets are under stress. A portfolio can look diversified in normal conditions, then become much more concentrated when assets start moving together. So pair diversification with downside measures like drawdown, stress testing, and scenario analysis.